Everyone, Jim Casbarro, GAFinestHomes Group, and today on our episode, we're going to help continue fulfill our mission to help you love where you live. And how cool would it be if you had a place in your neighborhood where you didn't have to pay a mortgage on? So wouldn't it be awesome? And probably if you're like me, you'd love where you lived a little bit more if you didn't have a home mortgage. So today we're actually going to talk about an advanced real estate investing tactic that you can use yourself to pay off your mortgage and accelerate your debt on any amortized loan in as little as 5 to 8 years, especially if it's a 30-year mortgage. So before we begin, I wanted to say that today's video is sponsored by one of our premium partners, Twisted Cycle. This is probably one of the best health and fitness classes I've ever been to. It's called Twisted Cycle, and Seth Carver is the business owner of this company. They have 2 locations up in Ackworth and Kennesaw, and if you're like me, I've been using Seth for about a year now. I've been going to him. I'm actually down about 30 pounds. Woohoo! And it's one of the best classes. The level of fitness, just so you know, is in between a Orange Theory and a CrossFit. And it's a 1-hour class. It's absolutely amazing. If you're in the area in Cobb County and you haven't tried it, definitely give it a try. It's an amazing experience. They use cutting edge technology. They have mobile apps, heart rate monitors to track how you're doing and your progress. And it's probably one of the best workouts I've had, and I'm feeling way better than when I did before I started. So we can get you a free class to try it. So just want to shout out to our premium partner, Twisted Cycle. And if you're curious, let us know. We'll get you more info. So let's jump into today's topic, which is going to be how to use an advanced real estate investing tactic to accelerate your debt payoff so you can be mortgage free in as little as 5 to 8 years. So probably the first question is, how in the world is this even possible? So let's start out by knowing how an amortized loan works, which if you're like most homeowners in our areas, you probably have a 30-year fixed rate mortgage. So basically, if you have any type of fixed rate mortgage, amortized over a length of time, and most mortgage companies have like 15, 20, and 30-year mortgages. For me and most of our clients typically go the 30-year route. And what that basically means is during the amortization process, when you closed on the home, I don't know if you probably noticed it, but it was a pretty lengthy, it's usually like 5 to 8 pages, and it has all of your mortgage payments broken down over that term. Well, if you've noticed, most of your payments, usually in the first half of your amortized loan length of time, so let's say your first 15 years, is going to be very heavily going towards interest. Now, obviously banks do this because they're in the business of profits, right? So they want to get their payments up front as soon as possible. So whatever your interest rate is, those interest payments are amortized over 30 years. So this tactic works not only with your home mortgage, but also with any amortized loan. And so here's how it works. A few things need to happen in order for you to actually do this. And the first thing, and this works really well with some of our real estate investors, because typically when you buy a rental property, you'll need about 20% down. And most banks will basically loan you on the property that you own an equity loan. And you have to hit a certain ratio. Now, most banks will go to about an 80-20%, meaning if once you build into 20% or more equity in your home, you have enough cushion where your, let's say it's a $100,000 house, for example, once you've paid into the property about 20 grand, then you'll have enough equity to do this tactic where you can actually pull out a home equity line of credit. Now, in some cases, depending on your bank, I've seen banks go as low as like a 90-10 ratio, meaning you only need 10%, but majority float around the 80, and do your homework on that regard and see what different banks have different offers. If you have excellent credit, got a great relationship with one, or even some of the local credit unions, they're even more flexible if you've got a relationship with them. So let's assume that you have some equity in your home, and let's just say it's in a marginal amount, 80-20%, right? So you've got 20% equity in your home. What you end up doing is you go take a home equity line of credit. And basically what this does is it's a loan on the equity in your home that the banks will give you. And what you do with this chunk of money, and it's usually not an exorbitant amount of money. It's probably anywhere from 10 to 40 grand on average. And I don't recommend taking out too much more unless you're in some pretty higher price points. Just because the way that this home equity line of credit works is it is a loan and you will have to pay it back. But what you end up doing though is when you take out this HELOC, this home equity line of credit, you immediately apply the total amount to your principal. Now, because it's an amortized loan for 30 years, the bank basically has it mapped out where they know how many installments it's going to take for you to pay back the full amount. Well, if you take a huge chunk, go right towards principal, you just eliminated an amount of time in order to pay off the loan. So this is a pretty phenomenal tactic. And what ends up happening is, let's say that you are a real estate investor, for example. You've got a rental property, and let's say that it generates a net profit of $400 a month. So after all your expenses, landscaping, whatever else you own on the property, you've got a $400 profit margin. This would be a really good tactic for you to do the home equity line of credit, take that chunk of money, pay it right towards your principal, and now let's say that that was a $30,000 loan, right? That equity line of credit's 30 grand. That $400 a month profit will pay off that home equity line of credit over the next couple of years. So as soon as that's done, you now repeat the process. Do another home equity line of credit right towards principal. So really, few things to make this happen. One, you need some equity. You need to have a bank lined up that will give you a chunk of money in a home equity line of credit for you to apply towards your principal. And I really only recommend doing this tactic if you have some rental income that's extra you can use towards it, or if you're disciplined in your finances. So meaning if you've got a couple $100 that you're saving per month, this would be a good tactic to explore. And a lot of those home equity line of credits, they basically act as like a checking account. So you can actually do all of your expenses through that HELOC, account essentially. They can give you a debit card, you can pay all your bills through there. And let's say that, after all your expenses, it takes X dollars a month for you to run your life and your family and whatever else. And you've got, a couple $100 saved up extra. You can now apply that and pay down your home equity line of credit over time. So by doing this, by taking these big chunks and applying it directly towards your principal amount, you end up cutting a significant amount of time off your 30-year mortgage. If you have enough equity and you're diligent enough, depending on how many times you do this and how big those home equity line of credit chunks are, you can basically take a 30-year mortgage, cut it down as low as 5 years, and possibly most people end up floating in between the 5 and 8 range. So some people do 12. If it takes a little bit longer, that's still fine. But imagine being free and clear in your property. In your head, when you think 30 years, it's a pretty long time. You can be doing that in as little as 5 to 8. So it's a fantastic opportunity if you play it right. And again, I don't recommend that you do this unless you're diligent in your finances. You've got a little bit of a spread you can put back to pay off the home equity line of credit. And I don't recommend doing anything else with the equity line of credit except paying it right towards your principal. That is the smartest tactic to do it if you're actually going to follow this process. So I hope this was pretty helpful. It's a fantastic way if you're diligent in order to pay off your home or rental properties or any property as soon as humanly possible if it's an amortized loan. And you can also, by the way, do this tactic with any other amortized loan. If you've got student debt or other personal property that you've got in loans or whatever it is, as long as it's amortized, you can kind of do this tactic and use lines of credit to accelerate it. A lot of our investors kind of call this what we call velocity banking. So it's basically accelerating your debt payoff by using lines of credit or equity, essentially in your home. So thanks for tuning in again. I hope this is a tactic that you can use to accelerate your debt payoffs so you can enjoy where you love where you live and enjoy your neighborhood much quicker by not having a mortgage payment. So thanks for tuning in, and I'll see you on the next one.